The repo madness continues. It has been a wild ride so far, but the media has already forgotten about it. Water under the bridge. Nothing to see here, folks. Well, in reality, the expectation is that it will actually get worse into year end, and the Fed is getting ready. JPMorgan, who may have been responsible for actually triggering the repo crisis, is making major changes to their portfolio, and some analysts are suggesting, despite what they're saying, JPMorgan seems to be preparing for a new financial crisis. Interesting indeed. You came here for the truth, so let me unveil that for you. Today we're going to talk about the Federal Reserve, my favorite topic. We're going to look at what's happening within the financial system, all interconnected with the repo madness and everything to do with the Fed and other central banks. Let's get into it right away. Always keep your eye on what's happening directly at the New York Fed website with the repo and reverse repo operations. You want to be focusing on this specifically because on a day-to-day basis, it's going to change. They're going to update their information here. It's still going on every single day. And I get the question all the time related to how long these particular purchases are dated for. And you can actually see the term of operation. If I zoom in here, you might be able to get a chance to see it a little closer. This will tell you how long this particular operation is, and you could see it in calendar days or business days, depending if it's on the Friday and so on. It shows you there 1 day, and now this of course hasn't happened yet, but if you scroll down, you're going to see one like this, for instance, where they show at the top here, maturity date is Wednesday, November 6th, the delivery date and the deal date happens to be November 5th. That's a 1 day, and it just gives you an idea of how long this is. In some instances, you will see 14 days. So here we have the term of operation being 14 days. Business days is 9. Okay, so this is something that everybody should keep their eyes on as we see this going on. Supposedly going to get worse into year end. I will have that information for you in future videos, but of course, if I don't cover it every single day, you should be checking on it. It's very interesting to say the least. Fed is open to changing its plan to calm the repo markets if necessary, top staffer says. The Federal Reserve is open to making adjustments to its program put in place last month to curb volatility in short-term lending markets that flared in mid-September, according to Lori Logan. On the last video I mentioned this very briefly, so we're going to go a little bit further into that today. The Fed has started to buy $60 billion worth of treasury bills every single month to boost its balance sheet, and this is going smoothly so far. The Fed expects to be able to maintain the current pace of T-bill purchases for some time. They claim that this will head into next year. They want to calm the markets for 2019, but it's going to be interesting to try and wean off of that. The market's not going to like that at all. But the Fed is prepared to adjust the pace, this is a key right here, is prepared to adjust the pace and other parameters as needed. The Fed is also willing to increase, very important, the size of repo operations going into year end, just as it did to keep rates stable over October's month end. We will monitor conditions closely and will be prepared to adapt to open market operations as needed. This is absolutely massive news that should be on the front page of all the papers, but nobody really gives a damn. All they want to know is the Fed easing or is the Fed tightening. If they're easing, it's risk on. That's right, risk on. So don't worry about anything else. Don't worry about what's happening and everything is crumbling. Don't worry about the economy either. All you need to worry about is what the Federal Reserve is up to. And ultimately, it boils down to this. Global liquidity proxy, you can see the money supply around the world. This happens to be over the last year and a half, but we have seen this time and time again throughout the years. The stock market, in particular the US stock market, happens to move in lockstep with the central bank balance sheets. There's no way that anybody can deny how accurate and how correlated these two are. far. Whether we're looking at specifically the S&P 500, the Nasdaq, the Dow Jones, or even on the Wilshire, it does look relatively in sync when you see it over time. There are fluctuations, as I've always said, but there's no denying that the US market is benefiting from the central bank devaluation of currencies. This is from the New York Fed website. Lori Logan, in her speech, had a few things to say. I mentioned it yesterday. I wanted to show you this very clearly here on the page. In October, overnight and term repo operations together resulted in a daily average of around $190 billion in total repos outstanding. Understand this, a daily average of $190 billion. That's how much the market needs every single day just to stay afloat. Now, they were already expanding their balance sheet before they made the official statement that they're going to be expanding their balance sheet. I showed you that here on the channel. This right here may not necessarily be all heading into their balance sheet. It's not a loan. It's not a bailout to particular companies, but it works in a different way. This is the first step. We see the trouble in the underlying financial system. The cracks have appeared. We have leaks in the boat. And what do? Well, they simply bail it out. And they're taking a bucket and they're trying to shovel out all that water, but they're not plugging up the holes. This is where we have issues time and time again. They cannot necessarily just go with a QE program outright because that's going to weaken confidence. They have to tell everybody, everything's okay. Don't worry about it. We're just going to do this. We're just going to do that. Have no fear. We are here to help. The next two charts actually come from the New York Fed website as well. You can see the outstanding temporary open market operations and what has happened since September 17th up until the present. Clearly, there are extreme levels of liquidity that are being injected, and nobody seems to want to talk about this unless they're saying that everything's fine. Reserve balances. This is really what this has all been about, at least for what the Fed has been talking about, that this went down too far. Of course, they're not going to mention what the reserve balances were prior to the financial crisis, but all of a sudden, now these are needed. Just like their balance sheet was unable to go below $3.5 trillion, the balance sheet that they're willing to admit, $3.5 trillion was apparently too small. So what do? Well, they have to increase that. That's why we have QE4 and the beginning of this new round of easy money. JPMorgan Chase has pushed more than $130 billion of excess cash into long-dated bonds and cut the amount of loans that it holds, marking a major shift in how the largest U.S. bank by assets manages its enormous balance sheet. Always pay attention to what JPMorgan is doing, not necessarily what they are saying, and I'll show you more about that in a second, but it is very key to take a look at this company because they are completely intertwined with the Federal Reserve. If you know the history of the Fed, you know exactly what I'm talking about. The moves, which have seen the bank's bond portfolio increase by 50%, are prompted by capital rules that treat loans as riskier than bonds. In the third paragraph, it's incredible, said an executive at a large institutional investor. The scale of what JPMorgan is doing is mind-boggling, migrating out of cash and into securities while loans are flat. So they're doing something that many of these other companies aren't, and JPMorgan oftentimes is ahead of the curve, not because they are smart, intelligent, or really good at guessing. It's because they're in the know. At the bottom of the article, they make something really clear. Not all analysts take such a benign view. This individual sees JPMorgan's balance sheet choices as part of a larger risk reduction strategy. The bank, he said, was, quote, acting like the next recession is here. Everything the bank is doing points that way. So whether or not that's where we're headed, it does look like JPMorgan is making some serious changes that are interpreted in this way. Just a quick note about what Lori Logan had said. She made the case for the central bank's program of buying only shortest dated treasuries to ensure the banking system has enough reserves, but she signaled an openness to make changes if they're needed to keep the markets calm. By confining itself to bills, the central bank can help maintain the supply of reserves while limiting the impact on financial conditions. Basically, right now, the Fed doesn't have that. If they started to do so, then it would really be helpful to the market, according to what she says anyway. We'll see how they change their portfolio. I really do think that the mortgage-backed securities are going to need some help in the coming years. This was interesting. The Fed found in an August 2019 survey of senior financial officers that the industry seemed to think it had adequate reserves. In the survey, which covered 43 domestic banks and 34 US branches of foreign banking organizations, institutions said the lowest comfort level bank reserves would be $652 billion. That was notably lower than the $1.1 trillion in reserves the banks held at that time. So they had suggested around this period, everything was fine. The reserves can go down a lot more. Now today, according to Powell, according to others in the Fed, that level of reserves was way too low and we need to get that up. That's why we had some problems. Don't worry, we're going to fix that. Interesting, isn't it? How you have all the biggest names in the industry saying one thing. I'm sure there were ranges, but in the end, they're never prepared for what's coming. You look at the stress test, you look at what happened during the financial crisis. Oh, we could have never have seen this coming. Well, I got an idea. We'll put this rule, we'll put this regulation in place to make sure it doesn't happen again. Then a few years pass, everything is calm and quiet. They just remove all of the safety features and allow things to get even worse than they were before. The Federal Reserve isn't the only central bank cutting interest rates. So many have. China makes its first cut in key lending rate since 2016. It was a very small amount. However, they're going in the same direction as all of the other central banks. Australia, although they didn't cut interest rates at their last meeting, they are now at 0.75 and heading all the way down to zero. They are desperately trying to support their housing market, which took an absolute beating, and bringing interest rates down might slow down the burn, but it's not going to stop it. Same situation in the UAE. They also brought interest rates down. I think they're at 2% if I remember correctly. And you can actually see a full list here at globalrates.com. That's global-rates.com, link in the description. All of these central banks here, for the most part, are decreasing interest rates. The ones that have increased, other than Norway, I can see that's the only example. The last time they increased was a little while ago, 2018 and so on. But in general, central banks are going down, down, and down. Some of them are in the negative. Many of them are close to the lowest they have ever been in history. It's crazy, but that's where we're heading. Goldman Sachs CEO suggested Europe's experiment with negative interest rates is holding the region back and probably won't look so good in the rearview mirror. This is exactly what I've talked about so many times before. It's a failure. Trying to do negative interest rates has not provided Europe or Japan or any of these other countries with any benefit. Quote, I think when we look back on negative rates, I think when the book's written, it's not going to look like a great experiment. There's no question that growth in this part of the world has been lagging, and negative rates have not allowed an acceleration of that growth, in my opinion. I can't believe I'm agreeing with Goldman Sachs, but in this case here, I simply can't deny it. It is completely accurate to suggest this, and I'm happy to see that somebody at this level is willing to admit it. Now, when the US goes in the negative rate direction, perhaps he'll change his mind, but for the time being, at least we have this acknowledgement here. And it seems like Jamie Dimon is taking from the exact same playbook. Check this out. JPMorgan Chase Chief Executive Jamie Dimon on lessons from the case in Europe. Quote, I think this is a lesson. I think they did it early to save Europe basically from coming apart with the monetary union. We don't know. I think they'll be writing books about this in 50 to 75 years. Negative rates has huge negatives for savers and low-income people, for investors, and for the capital markets. I'm I personally would not buy debt below zero. There's something irrational about it. I'm not sure the monetary rules are the same for negative rate as they are for a positive one. And again, I can't believe it, but I agree with Jamie Dimon. So JPMorgan and Goldman Sachs are right on the money with this one. It's insane where they have let negative interest rates go. They've created such a problem for the future, and there's no way to fix it. I'm going to end the video there. If you found it informative, hit that thumbs up button. Don't go anywhere before you hit that button. It really helps to support the channel. Thank you very much. If you want to build a business, if you want to make money, if you want to learn about passive income, then this course, which is completely 100% free, is for you. This is the Amazon GPS. I made this to help people actually make an income for themselves, either on the side, maybe on the weekends, maybe they want to replace their 9 to 5. It's all up to you. I simply give the information. Check it out at theamazongps.com. If you want to learn about central banks, if you want to learn about interest rates, if you want to understand how the financial system actually works, I explain it in detail in these two books without any jargon, without any of that garbage that actually confuses people intentionally. Check them out at the link in the description if you want the audiobook that's available at themoneygps.com. Okay, so this video is a big deal. Okay, if you haven't seen it yet, 100% you have to watch it. Click on it and I will see you there.